All right, well, let's continue that China conversation. Of course, economic growth is in focus today with its GDP data, forecast for growth at 5.5% on the quarter over the year basis. But that sort of kind of growth, is it good enough to help lift Australia out of recession? Well, Paul Ashworth, CIO at Cameron Harrison, joins us via Skype from Melbourne. Thanks for joining us this morning.
Hi, thank you for having me.
All right, so you're getting those figures in just under 2 hours' time, but what's your expectation?
Look, we expect that pickup will be reasonably robust, and we expect that to continue over the course of the next 12 to 15 months. The concern that we have is really beyond that 15-month lookout period, and how it is that markets are incorporating those risks beyond 15 months, and if you like, really how they're incorporating an environment as stimulus both here and in China starts to reduce, and we get to more normal government actions, particularly in China.
Okay, so Paul, is that the risk? So talk to us about the risks that you see out in that longer time frame.
So, if we look at the last 10 years in terms of growth in China, we've effectively seen, we're talking about the figures now, we've effectively seen a halving in economic growth, from 10% to around 5%. And the important thing is that we see growth over the course of the next 10 years halving again. And that's the, if you like, the real salt and rub for Australia. Why? China, comes into the next 10 years in a very different position to developed economies. It is coming into this environment with a demographic situation in terms of an aging population, and a working age workforce, relative to its population over 60 years of age, that's going to turn negative, in a substantial manner. That's already started, and we can see, what an aging population and demographics has done to economic growth around the Western world. Well, China approaches that, and it approaches it, with GDP per capita, income per capita, at very low levels. So, we think that's problematic for Australia, and obviously for some pretty obvious direct reasons in terms of bulk commodities and specialised commodities, services, and on an indirect basis, in terms of migration, which is, as we well know, Australia has led that over the last 5 years, in terms of migration per 1,000 people of population. That's a big challenge.
Yeah, a couple of factors also playing into mind at the moment, as far as the pandemic's concerned and the closure of borders, plus the political situation between Australia and China. But longer term, do you feel as though once we get past that, assuming the political standoff is resolved between the two countries, that you will see that continued pressure on commodities and also the education sector too, of course?
Yeah, well, I think certainly the what we could describe as the political tete-a-tete, on a bilateral basis between Australia and China, is obviously pretty significant. But 10 days ago, we're talking about coking coal. Well, if we look at the what's sitting there in terms of stockpiles, in terms of iron ore and coking coal, maybe you can't blame the Chinese. They are sitting on substantial stockpiles. As your previous speaker spoke about, America is obviously important in terms of trade commitments under their trade deal, and it may well be, other than just the political tete-a-tete, that Australia is the thin edge of the wedge in terms of the balance up in terms of those trade obligations that China has to America in terms of its trade agreement.
Hey, so Paul, markets are very forward-looking. You don't believe that they are pricing in this inevitable slowdown in the rate of Chinese growth that we've become very accustomed to as investors, particularly in the materials space. So,
Sure.
As CIO, do you start getting out of any exposure that you have to the big names?
Sure.
Because right now, if you take a look at the iron ore price, I mean, Fortescue's digging it up and selling it at such a price. I mean, how do you sort of time reducing your exposure potentially to those sectors?
Well, first of all, I'd say get it out of the ground as quick as you can. But I think it's it's an awkward period because whilst we're talking about that medium to long term impact in terms of China, we've got to counterbalance that with what's happening in terms of governments here and China and elsewhere around the world. What they're trying to do in terms of their own domestic demand. As they're trying to work through COVID and try to get to some economic normalisation. So it's a tricky balance, over that beyond that 12-month period. We can certainly note in terms of Australia, a lot of the stimulus starts to really fall away from May of next year, and we are reliant on the numbers in terms of China and demand and iron ore and coking coal and state royalties, corporate taxes. So I can see that and we can see over the course of the next 6 months, that starts to come into focus as people start to move beyond, if you like, looking at I suppose they've been called the retaliatory type actions that China is unofficially taking. It'll come more into focus as to what is the actual realities here, and the reality is we think that they just don't need as much from us.
Yeah, indeed, that's a bit of a reality check, isn't it, Paul? Thanks very much for joining us from Cameron Harrison.
No, absolute pleasure.